You're sitting in your car, engine still running. You just checked your investment account before walking into work. Just a quick check, 20 seconds. The number is fine. It's always fine. It's just never quite as fine as you expect it to be. And that's the strange part, because by every reasonable measure, you're doing everything right. You have a stable job. You save consistently. You invest in index funds. You didn't panic last time the market dropped. You're playing the game exactly how it's supposed to be played. And yet, there's this quiet feeling, like something isn't adding up. Now imagine your co-worker, same office, same salary, same starting point 5 years ago. They're doing the same things, same contributions, same strategy, same discipline. And if you ask them privately, they'd probably say the same thing. I think I'm on track, but I'm not sure for what anymore. Because here's the part nobody says out loud. This doesn't feel like a normal cycle. We've been trained to understand the economy in a very specific way. Growth, then slowdown, then recession, then recovery. Repeat. It's predictable, almost comforting, because no matter how bad things get, there's always the same ending. It comes back. 2000, 2001, 2002, different causes, same story. The system bends, then resets. But what if this time, the system isn't just bending? What if it's shifting, not breaking, not collapsing, just changing? And that's much harder to see because change doesn't announce itself. It doesn't feel dramatic, it feels normal. Your rent goes up a little more than expected. Groceries feel slightly more expensive every month. Your investments still grow, but slower than they used to. Your safe assets don't feel as safe. Nothing breaks, but nothing feels quite stable either. And the danger is, most people don't react to slow changes because there's no clear moment to react to. Let me show you what I mean. Think of the financial system like a game. For the last 40 years, it's been the same game. Low inflation, falling interest rates, stable currency, stocks trending upward over time. Everything you've been taught, every strategy you follow, every retirement calculator you've used, all of it is built on that version of the game. But here's the problem. That game only works if the rules stay the same. And right now, there are signs the rules are shifting. Quietly. So over the last few years, we've seen things that don't fit neatly into the old cycle. Massive amounts of money created in a very short time. Not gradual, not controlled. Fast. Government spending at levels we haven't historically seen outside of crises. Global financial systems being used as tools of power. Countries being cut off and forced to find alternatives. And slowly, almost quietly, some countries are starting to trade without relying on the dollar. At the same time, central banks around the world are buying large amounts of gold. Not for speculation, not for hype, for stability. These aren't random events, they're signals. And when you line them up, they don't point to a normal recession, they point to something deeper, a transition. There's a way to understand this that makes it much clearer. Think of the global financial system like a lease agreement. After World War II, the world made a deal. The US dollar would sit at the center of everything: trade, energy, debt. In exchange, stability, security, predictability. That agreement has held for decades, and for a long time, it worked extremely well. But long agreements come with a problem. Over time, the terms start to stretch, the system becomes more dependent, more leveraged, more fragile, and eventually, the participants start asking a simple question. Do we still want to operate under these terms? That's where things get interesting. Because transitions don't start with a collapse. They start with small shifts. Say, one country settles trade in a different currency, another reduces exposure to the system, another quietly builds alternatives. No headlines, no panic, just gradual movement. And from the outside, everything still looks fine. Markets are still open, people are still investing, retirement accounts are still growing, but underneath, the structure is adjusting. And this is where most people get caught off guard, because we're trained to look for big events, crashes, headlines, clear signals. But real financial shifts rarely happen that way. They happen slowly, then all at once. Now let's bring this down to a real person, because this isn't about theory, it's about how this actually affects someone like you. Meet David. He's 42, makes about $110,000 a year, he's been consistent, saving, investing, following the plan. He has around $350,000 invested, mostly in index funds, target date fund, nothing aggressive, nothing risky. According to every tool he's used, he's on track. By retirement, he should have around $1.5 to $2 million. That sounds like success. But that projection depends on something very specific. Actually, 3 assumptions. First, the market continues returning around 7% per year. Second, inflation stays relatively low, around 2 to 3%. And third, the dollar maintains its purchasing power over time. If those 3 things hold, David's plan works. But if even one of them shifts, the outcome changes. Not slightly, materially. And that's where we are right now. Not in a collapse, not in a crisis. In a moment where the assumptions themselves are starting to move. And that's much harder to see because there's no alarm for that. No breaking news notification. Just a quiet feeling that something isn't behaving the way it used to. And most people will ignore that feeling because everything still looks fine. Until one day they realize the game they were playing, it is not the same game anymore. Now here's where it gets uncomfortable, because if the rules are shifting, then the math changes with it. Let's go back to David. On paper, he's on track for around $1.8 million by retirement. That's what every calculator tells him. But those calculators assume something very specific. They assume stability. Let's change just one variable. Inflation. Instead of 2.5%, let's say it averages 5%. Not extreme, not catastrophic, just higher than expected. Over time, that difference compounds quietly. And by the time David retires, that $1.8 million doesn't feel like $1.8 million anymore. In today's terms, it might feel closer to $800,000. Same number, different reality. And this is where people get blindsided because nothing looks wrong. The account balance is still there. The system didn't crash, but the outcome changed. Now layer in something else. Interest rates. For years, rates were low, which made borrowing cheap. Cheap money pushed asset prices higher. Stocks, real estate, everything. But when rates rise, that equation reverses. Higher rates mean lower valuations. Suddenly, the same investments don't behave the same way. That safe bond fund, it starts losing value when rates rise. That stock market growth everyone expects, it slows down or becomes more volatile. And here's the key point. None of this requires a crash. It just requires a shift in the environment. This is what makes it different from a recession. A recession is a temporary disruption inside a stable system. This is a potential change to the system itself. And when the system changes, the strategies built for the old system don't always work the same way. Now here's where psychology comes in, because this is the part that traps most people. Humans don't react to slow change. We normalize it. If prices go up overnight, we notice. We react. If they go up slowly over years, we adapt. Same with financial systems. If something breaks suddenly, everyone pays attention. But if it shifts gradually, most people continue doing exactly what they've always done because it feels safe. And there's a deeper reason for that. We anchor to the past. We assume the future will look like the recent past because that's the only data we have. For the last few decades, the strategy worked. Invest consistently, stay patient, let time do the work. And to be clear, that strategy still matters, but the environment it worked in may not be the same going forward. And that's the difference. It's not that the strategy is wrong, it's that the assumptions behind it may no longer hold. There's a simple way to understand this. Think of it like playing a game you've mastered. You know the rules, you know the patterns, you know what works. Then one day, without telling you, the rules change. The board looks the same. The pieces look the same. But the outcomes are different. And if you keep playing the old way, you start losing without understanding why. That's what financial transitions feel like. Not chaos, confusion. Now here's the part that most people don't expect. The people who struggle the most in these transitions aren't the reckless ones. They're the disciplined ones. The ones who followed the plan perfectly, saved consistently, invested patiently, trusted the system because they optimized for stability in a system that was stable. But if the system shifts, their strategy becomes misaligned. Not because they made mistakes, but because the environment changed. And that's why this matters, because right now, most people are still playing the old game. They're focusing on the next recession, the next market drop, the next recovery. But they're not asking a more important question. What if the system doesn't behave the same way after this? Because the biggest risk isn't the recession itself. It's assuming what comes after will look like what came before. And historically, that's not always true. Sometimes what looks like a normal cycle is actually the beginning of a transition. And transitions don't feel dramatic at first. They feel like this: slightly higher costs, slightly lower returns, slightly more uncertainty. Nothing extreme, just different. Until one day, you look back and realize the entire environment has changed. And by then, adjusting is much harder, say. So what do you do with this? Not panic, not predict, just understand. Understand that the game may be shifting. Understand that assumptions matter. Understand that outcomes depend on the system, not just your effort inside it. Because at the end of the day, this isn't about timing the market. It's about recognizing the environment you're operating in. Because the people who do well in the next decade won't be the ones who predicted the crash. They'll be the ones who understood that it wasn't just a crash. It was a transition, and they adjusted before everyone else realized the rules had already changed.